What's better, credit spreads or debit spreads? That's a question that I get all the time, and in this video, I'm going to try and distinguish the two spreads and to tell you why I favor one over the other. Hello, traders. This is not meant to be a comprehensive educational program on spreading. There are a lot of free resources that you can use. I'm going to list them in the description area below this video so that you can learn more about them. There are also some fantastic books that are written. I don't really teach option strategy here because there's so many other good resources that you can use. So under the assumption that you already have some familiarity with spreads, I'm going to build on that and to tell you why I prefer one spreading strategy over another. Basically, option spreads are used to defray the cost of the position and to reduce risk. They're created by selling an option and by buying an option. If the option expiration is identical for both legs of the spread, it's called a vertical spread. A vertical spread where you're selling a closer to the money option and buying a farther out of the money option is called a credit spread. So let's hit pause very quickly here. Let's think about this. You're selling a closer to the money option, so it's going to have more premium. That means that you're going to be receiving money in, more money than what you're going to be paying to purchase the farther out of the money option. Credit spread, you're receiving money in. A vertical spread where you're buying a closer to the money option and selling a farther out of the money option is called a debit spread. Again, intuitively, closer to the money, more premium, so we're having to lay money out for that spread, hence the term debit spread. So let's talk about credit spreads. A bullish vertical credit spread has a neutral to bullish bias, and they're called bullish put spreads, bull put spreads, or put credit spreads. So in this particular instance, we're expecting the stock to stay right where it is. It could move just a little bit lower, that's fine also, or to gradually move higher. And so what we are doing is we're selling out of the money puts with the short strike price closer to the money and the long strike price farther out of the money. And so this spread is established for a credit. The difference between the strike prices minus the credit that we receive is the maximum position risk. And that's also the exchange minimum margin requirement that you have to put up. This is what the graph looks like for the P&L. And you can see typically the stock is going to be much higher, and we're looking to distance ourselves from the action, and our opinion is that the stock will be able to tread water or move higher. In that instance, we get to capture this credit, that's our maximum profit, and the options continue to whittle away with time decay, we get to keep the premium. But if the stock starts to lose its mojo and it starts to drift closer and closer to that short strike price, we start having that credit disappear until finally we are losing money, but at some point our losses are capped off and we would take the maximum position risk on that, and that's why that flattens out down here. But this is the P&L graph for a bullish put spread. So we also have credit spreads on the call side. A bearish vertical credit spread has a neutral to bearish bias. They're called bearish call spreads, bear call spreads, or call credit spreads. So the call that's closer to the money is sold, and the call that's further out of the money is purchased to open. The spread is established for a credit. Again, the difference between the strike prices less the credit received is your maximum position risk, and that's also the exchange minimum margin requirement. So let's say that a stock has peaked and it's starting to roll over and it's coming in hard and it's broken some major technical support levels. In that instance, your opinion might be this stock has really good downward momentum. I believe at best it treads water. At worst, it keeps going down. So I want to sell calls that are out of the money that are likely to expire. That's when you would use a call credit spread. And here's what the P&L graph looks like for a call credit spread. And you'll notice that your opinion is that the stock, which should be way down here below the short call strike price, Your opinion is the stock is going to keep heading lower this way. But if it does that, you'll get to keep the credit that you receive for it. If by chance you were wrong and the stock starts to inch its way higher and it gets above that short strike price, now you're going to start losing money and your losses on the upside will be contained because you've created that spread. That is what the P&L graph looks like for a bearish call spread. So we also have debit spreads. Now we're going to be buying options that are closer to the money and selling options that are further out of the money. So a bullish vertical debit spread has a neutral to bullish bias. It's called a bullish call spread, a bull call spread, or call debit spreads. So the call that's closer to the money is purchased to open, and the farther out call is sold to open, and the spread is established for a debit. Now, that debit that you paid for the spread, that's your maximum position risk, and that's also the exchange minimum margin requirement that you have to put up. So if you buy an option for $2 and you sell an option for $1, that's going to be a $1 debit. That $1 is what you have to put up in margin. Now you'll notice here, this is what the P&L graph looks like for a bullish call spread. And you'll notice that the stock, as it continues to go up in price, you are able to make more and more money on that spread until eventually you reach your short call strike price and then your profits max out. If the stock happens to head against you, then you're going to lose money and your risk will be capped off at the debit that you paid for that spread. So that's what the P&L picture looks like for a bullish call spread. Buying closer to the money option, selling farther out of the money option. Bearish vertical debit spreads have a neutral to bearish bias. They're also called bearish put spreads, bear put spreads, or put debit spreads. So the put that's closer to the money is purchased to open, and the farther out put is sold to open. The spread's established for a debit. Debit paid for the spread is also the maximum position risk. And that's also the exchange minimum margin requirement. Now, the most money that you can make on this is if you take the difference in the strike prices of the spread and you subtract out the debit that you received. The difference would be your maximum profit potential on the trade. And here's what the graph looks like. You can see that as the stock goes down in price, and this is your opinion, is hey, this stock really looks like it's going to be going down. I'm going to be buying some puts that are closer to the money. I want to defray that cost by selling some farther out of the money puts. That's when you would want to use a put debit spread. And you can see that as the stock continues to go lower, you're going to continue to make more and more money until finally you've reached that short put strike price and your profits are capped off. So as the stock continues to go lower, you'll max out your profits. Now, if the stock starts to rally, you're going to start losing money, and that will be capped off at the debit that you paid for that bearish put spread. Now, let's make all of this so much easier. All that mumbo jumbo, oh, let me try and get all this straight. Here's what really matters. If you take a look at the P&L graph, on the left, you're going to see this is a bullish put spread, and this is the P&L for a bullish put spread. On the right side, you're going to see the P&L for a bullish call spread. Hey, wait a minute. These two look identical. That's right. They can be identical. And I'm going to show you how for every credit spread, there is an equal debit spread. Well, heck, if they're equal, then what's the difference? I can do one or the other. That's right. You really can. So everything that I'm going to be teaching you, there are some subtleties that make me favor one strategy over the other, and I'm going to explain those. But know that the overall P&L is the same. Now, yes, if you started selling farther out of the money bullish put spreads, it would not be the same as buying a farther out of the money call debit spread. But I'm talking about using equivalent positions here and why I favor one over the other. These are all the positions that we had on recently, and you can see there are a couple of points that I'd like to make. One is, especially if some of you novice option traders are still watching this video, you really need to learn how to do vertical spreads. And the analogy that I would make to this is that most traders come in and they buy calls and they buy puts. Those strategies require absolute perfection. There is no margin for error, and especially if you're buying short-term options, you have to have ideal market conditions for that strategy. You have to have ideal stock conditions for that strategy to work. And I would equate it to, and options get so much publicity and there's so much hype around them. Make $1 million overnight, 300% winner, 500% winner. You see all this type of stuff on social media, on YouTube, that it raises unrealistic expectations of why you should trade options or what you should be doing with them. And I equate it to somebody who's just learning how to play golf. Well, if I'm going to learn how to play golf and I'm going to play, well, then I'm going to go use what the pros use. I'm going to go get some blades and I'm going to get some Titleist UV1 golf balls. I want to have the absolute best when I'm playing. Well, the pros know how to hit those clubs and they require absolute perfection. And all of a sudden, here you are, a novice golfer, and that's going to be your strategy. Well, that's equivalent to going out and buying options. On the other hand, what you should be doing if you're a beginning golfer is you should get clubs with the largest sweet spot. It should have a sweet spot the size of a grapefruit. That's what you need. And that's what spreads offer you, is they offer you a very high probability of success. So if you don't get your market analysis absolutely perfect, if you don't get your stock analysis absolutely perfect, there is a big sweet spot. There's cushion. There's room for error. So please learn how to do vertical spreads. If you're just starting out with options, this is the strategy that you should be using. So these were the positions that we had on recently. All the ones in green are ones that expired, and these two we were not able to get into, so they're in yellow, and that left us with 3 positions on, and actually 2 of them expired last Friday. So more success, and you can see the success rate that we've had all year has been right around 90%. So very, very high success rate. And we will have 1 position on going into the last week of the year, this Amazon spread. Now there are 2 positions that I want to highlight today. One is this Intel spread that we're going to take a closer look at, and the other one is ZS, because the chart sets up well and I can really tell you why I'm favoring one strategy over the other. So here's a chart of ZS, and I'm going to talk a little bit about the cushion of selling out of the money credit spreads. You can see that ZS had this beautiful breakout here, long green candle after an earnings announcement. So everything looked fantastic. When I recorded a video and when I was looking for trades, I said, this stock wants to go higher. So what we're going to be doing is we're going to hope that the stock comes back in and tests the middle point of this long green candle. If it does, what we're going to do is we're going to be selling a bullish put spread, a put credit spread below this technical support line at 160. So that is our premise for the trade. We think the stock is going to go higher, but at very worst, this stock comes back and it checks the breakout. And at that time, we also knew that we had a market that was being fueled by seasonal strength. Everything was looking good for the market. It should continue to tread water or move higher. So all the pieces were in place for this strategy. And so you can see how the stock did gradually move higher and it actually broke out. But that was the premise behind the underlying trade. Now we're also trying to increase our probability of success by looking for other characteristics within the stock. For instance, heavy volume, relative strength. There are candlestick patterns that we look for. We have proprietary buy and sell signals. All of these help us increase our probability of success. So when we're selling these spreads, a lot of novice traders will take a look at a credit spread and they'll go, wait a minute, I can make 50 cents on this, but I could lose $2. How does that make sense? Well, if there were a 50-50 probability of success, that would be a horrible trade. But if there's a 90% probability of success that we get to make the 50 cents and only a 10% chance that we lose the $2, then all of a sudden these credit spreads start to make a whole lot of sense, and it's consistency, and that's what novice traders need is consistency. And once you start getting your consistency down, then you can start to spread your wings and get more aggressive. So let's take a look at two different approaches to the same trade, which was on ZS. And I'm just going to go back to the chart very quickly. Okay, so we have a neutral to bullish bias on this stock. One thing that we can do is we can sell an out of the money bullish put spread below the strike price. We can also buy an in the money call debit spread. So as the stock goes higher, that also is neutral to slightly bullish. So let's take a look at the P&L for both of these. So what I'm going to be doing is I'm going to be on the put side. Now let's do the call side first. I would be buying the deep in the money 157.50 calls, and I would be selling the 160 calls. Now these options weren't anywhere near this expensive when the spread was established because the stock was still down at about $170 or so. So that would be one approach that we could use. We could buy a call debit spread. Now, if we were going to put this spread on, we would be paying a debit of $2 for it. There's $2.50 between the strike prices here. So our maximum profit on that would be $2.50, the difference between the strike prices, less the debit that we paid for the position, which was $2. So our max risk on the position is $2 because if the stock falls down to $100, those 157 calls that we bought, they're going to be at zero. So our maximum risk on a call debit spread is the debit that we paid. Now our max profit potential on this is 50 cents. So again, 50 cents divided by the maximum risk of $2 yields us a 25% return. If we look at the flip side of this trade, we can sell the 160 put and buy the 157.50 put. And in this particular instance, we have to put up the difference in the strike prices, $2.50, but we receive in a credit of 50 cents. So 250 minus 50, that means that our max risk on the position is $2 and our maximum profit on the position is 50 cents. Now, if this spread expires worthless, we kept the 50 cents, we had to put up $2, we're going to make a max profit of 25%. Now, the one thing that I should mention on these spreads also is that we don't take the maximum hit on these spreads. We're evaluating market conditions, we're evaluating stock conditions, and we are going to mitigate that risk. If technical support is breached where we expected it to hold, then we're going to be buying the spreads back. Can we get blindsided by some news? Yes, we can. And I'm going to show you one instance where we were blindsided by some news, but we were able to exit the trade successfully. Another reason that I prefer to have a put credit spread or a bullish put spread versus buying a call debit spread. So why do I sell credit spreads? Number one, and this might sound cocky, I'm right most of the time. Well, for this particular strategy, because I'm only bringing in, say, 50 cents, but I'm risking $2, I dang well better be right most of the time. If I'm not, I better find a new profession. In fact, 90% of the time, I'm going to be right. So I have to go with that premise. Well, if I'm right most of the time, what advantages does that have? And here you can see that's my short strike price right here at $160 below this technical support. The open right there of that gap is going to be support, and that also lines up with resistance right there. So the underlying premise is that the stock is going to stay flat or move higher, and I'm going to be right on this trade. If I'm right on that trade, then here's what happens. You can see how these options start to get less and less in value. In fact, there's no bid on these options as we get close to option expiration. So the put option that I sold gets super, super cheap, and the one that I bought further out of the money also gets very cheap. And eventually, this position will expire worthless. You can see what happens on the call debit side is these options get super expensive. And in fact, look at how wide the bid-ask spread is on that. It's $4 wide on the 157.50 calls, and it's almost the same on the 160s. So it's very difficult to find out where you might possibly be able to get out of this spread. Now, since these two strategies are equal, I'll show you a little secret. If you ever get into this situation and you're long a call debit spread, what you can do is calculate where you think you'll be able to get out of the put spread. So let's say that I looked at these prices and I felt that I could purchase this put spread for a dime. Well, because there are $2.50 between the strike prices, $2.50 less a dime, I know that this side is probably going to be trading for $2.40. So they have both sides, the credit spread on one side, the debit side spread on the other side, have to add up to the difference in the strike prices, which is $2.50. So if I have to pay 10 cents to get this one back in, then this one's going to be trading at about $2.40. So just a trick that you can use. But if I'm right most of the time, then I can expect that the stock's going to at least hold its own or move higher, and these options are going to get cheaper and cheaper and cheaper. And now I can be a penny bid for these. I can be a 2-cent bid for the 160 puts if I want to shut that trade down early. So I've just covered why they're easier to exit. We don't have options that have gone up dramatically in value, where it's harder for me to assess if I can get out of that spread or not. The other thing is that when they're out of the money like that, I don't have to worry about assignment. So let's go back to that instance here. These calls, I could get knocked out of the trade, which is fine, because one day my brokerage firm calls me up and says, hey, you were assigned on your 160 calls. What do you want to do? Oh, well, I want to exercise my 157.50 calls that I'm long. That will flatten out the position. You'll make your $2.50. Great. Maximum profit achieved on the position. So it's good news, but there are transaction costs associated with exercise and assignment, and they tend to be much higher than your normal commission rates if you were buying and selling the options. In this instance, I don't have to do a thing, and I don't have to worry about possible assignment early. The spread's just going to expire worthless. I can choose to buy it back in to release margin. I can choose to buy it back in if the market conditions change and look a little bit shakier. I can be bid for these options for pennies, and I can shut it down early. Or if I don't need to release the margin, they just go away. There are no transaction fees. Again, if I'm right most of the time, I'm not going to have any transaction fees by selling out of the money credit spreads, but I am going to have transaction fees if I'm right because of exercise and assignment or because I'm needing to sell the spread. So that's why it's easier to exit these spreads. The other thing that I want to demonstrate is that I can leg out of the spread. So let's take an instance where it's not working out for us and I'm needing to repurchase the options. Well, we'll just use this screen even though the prices are off. Let's say that the stock starts to head down, and now all of a sudden CS is below 160, what I can do is I can repurchase the 160 puts. And if the momentum in the stock to the downside is very, very strong, I can repurchase the 160 puts and I can leave the 157.50 puts on with the notion that the stock is going to continue to move lower and these 157.50 puts are going to increase in value. I can do that trade. I just have to be able to afford to buy the 160 puts back. Now, legging out is something that you should take extremely seriously because you can take a bad situation and make it into a horrible situation. And the way that happens is you buy back your short put you buy back your short put position. Now you're just naked long the 157 put. Your bias on the stock has gone from neutral to slightly bullish to flat out hardcore bearish. And if that stock doesn't keep going down and it bounces, now you're going to be left with a monstrous loss. And these options will be fairly expensive that you're buying back because the stock has been heading lower. So you can leg out of these spreads though. So you can buy back your short put and let the long put run. And I've got an example that I'm going to show you on that. Now let's take a look at the flip side. Let's say that I'm long a call debit spread and the bottom starts to fall out of the stock. Woo-wee. Well, that's okay because I'll just sell my long call position. So you enter the order with your broker and it says rejected, rejected. Whoa, what's going on with that? Well, if you were selling your long call position, that's going to leave you naked short the 160 calls in this instance. And that requires the highest level of option approval, and it's going to incur a huge margin requirement. And the brokerage firms are not going to let you do that. They're not going to let you leg out of a call debit spread. So that's another reason I prefer to sell out of the money put credit spreads. I can leg out of the position. So let me show you a trade that we just had on last week, and it was Intel. It was one of the trades that I showed you on that spreadsheet earlier, and here was the premise to the trade. So we had Intel, nice double bottom, higher low, nice little uptrend here. We had a big drop in the stock here after its earnings announcement, but the stock was able to regain its footing and it was able to break out through this horizontal resistance level. Also, it was able to get above these major moving averages, the 50-day and the 100-day. Everything looks pretty good in here. Maybe it got a little bit too hot in here, but it pulled back and it consolidated some of its gains. Here we had a breakout above this downward sloping trend line, so this would be a bullish flag formation. That's a nice candle right there. Everything's setting up very, very well. Well, this is when we entered the trade. The notion for the trade was that the stock would continue to tick. Whoops, got to go back one slide. The notion was the stock would continue to tick higher. At very worst, we expected this horizontal support level to hold. The 100-day moving average was at $49.10, $49.10. So we expected that support level to hold. Stock could just bide its time here. It could float higher. We would make money in both of those scenarios. Also, there was a chance for the stock to continue filling in this little part of the gap here. So we had everything in place. The premise behind the trade was excellent. No problem. I would do the trade again. But lo and behold, on Friday, that's the price action that we saw on Friday. Whoa. Intel doesn't make moves like that. It went from $51 to $47. It rarely moves $4 in a day. And you can see the monstrous volume. Well, our premise that the stock would hold this support level was flawed. There was news. Microsoft announced that they were going to be developing their own chipsets and they would no longer be using Intel. They have had a long-standing relationship, and this is devastating news for Intel, and it comes after Apple had already announced similar earlier in the year. Two monstrous big customers have said that they're going to be developing their own chips and could even be competitors for Intel. Well, that's the type of material news that you cannot predict. It comes out, and all of a sudden the stock goes in a free fall. This is our spread right here, this blue line. So that was our short strike price, that was our long strike price, and you can see, whoosh, we're through both ends of it. So the analysis here is that I was wrong, and this is a legitimate breach of technical support. Not only did it fall through the 100-day, it fell through the 50-day, and it closed near its low of the day. So this tells me, warning, I have got to close this spread down. Now, for most of you, that means that you should just put an order in and try and buy that spread back. And if we had $2.50 between the strike prices, you should try and buy it back maybe for $2 or $1.75. Try and take the hit, clean the slate, move on. Now, as I mentioned to you earlier, you can leg out of these spreads, but in a market that has been floating higher and higher and higher on seasonal strength, we are in an 11-year bull market rally. We are in an 8-month bull market rally. If I buy these Intel puts back, now I am assuming that the stock is going to continue to move lower, but I also need the market to move lower. If the market rallies hard, this stock could bounce. So I buy the short put back and the market bounces and the stock bounces. I am going to be left holding the bag in a major, major way. And that's the mistake that most novice credit spreaders make, is they forget to evaluate market conditions. But we had a really good setup this week where the market was going to cooperate for us. And it happened right on the open Monday morning. So when I saw the futures down overnight, 60 S&P 500 points, I knew that we had a window of opportunity. I knew that I would have a market tailwind working in my favor. So in this case, yes, we legged out of the spread. And what we did was we bought back the $49 puts on Intel and we hung on to the 48.50 puts. And the instructions were to sell the 48.50 puts at the same price that we paid for the $49 puts. And there's what the market did. So you can see it was strong going into the close Friday. We have that news, devastating news over the weekend that there's a new strain of coronavirus. Everybody got really, really scared about that. And so the market reacted to that news. I knew I would have this tailwind from the market and that the stock would also continue lower. And that's what happened. You can see here how low the stock got during the day. So it opened pretty much on its high of the day and it sold off with the market, and that allowed us to successfully leg out of that position. That's another reason that I like selling out of the money bullish put spreads versus buying call debit spreads. If something disastrous happens like this, I have the flexibility to buy back that short put and I can let the long put run. Now, you want to make sure that you've still got time till expiration on your long put. You wouldn't want to be doing this 2 or 3 days before expiration, because then you've got an incredible amount of risk. If the stock just bounces a little bit, you're in trouble. If the stock sits flat, you're going to be losing time decay. So you need to do this type of legging out when you still have at least a week, hopefully a week and a half left in the life of those long puts. No exercise and assignment. I had mentioned this to you earlier, how this spread I have to take action on. If I buy a call debit spread, that means that I'm either going to have to sell that spread or I could go through exercise and assignment. In which case, if I'm assigned on these 160 calls, I'm going to be short stock at 160. I just tell the brokerage firm to exercise my 157.50 calls, which allows me to buy the stock at 157.50. Now I'm incurring transaction costs on this side. No action required. Spread expires worthless. So again, keep in mind that for every bullish put spread, there is an equivalent call debit spread. They are equivalent positions, but there are some subtleties that force me to lean towards selling bullish put spreads. I also just like the notion of having time decay continually tick, 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 whittle away, whittle away, whittle away at the position. Now, this is just a warm fuzzy. This has really nothing to do with anything. But if I look at my brokerage account and I've sold a put credit spread, I can see these things whittling away and I can see the profit increasing on these spreads pretty much on a daily basis when they get in their last week of life. You don't get that same benefit here because these options are, the bid ask spread on this is so wide, who knows where the brokerage firm is going to mark that spread anyway. Do I ever buy debit spreads? Yes, I do buy debit spreads. It's not that I don't ever use the strategy. I tend to use it more when I'm very bullish on the underlying stock and when I'm assuming that the stock is going to be making a big move. So here are the instances where I like doing debit spreads. And this is in a longer term position, and it would be after a big market drop. So let's say that in March, April, when the market had really come in hard after the coronavirus hit the United States, there you'd be looking to buy out of the money longer term options that might have a 3 or 4 month time span. When I do buy those spreads, I want to make sure that I have plenty of distance between the strike prices so that the closer to the money calls have a higher delta than the calls that I've sold out of the money. Now they will naturally, but I'm looking for a spread where I have a net delta of zero point 0.5 or higher, meaning that the front month or the closer to the money option has a higher delta. And when I subtract out the short strike delta, that I've got 0.5 is what I'm working with. The idea here is that the stock is going to rebound longer term over time, and that gradually that spread will increase in value. And I typically, on these big market drops, I still want to make sure that I'm selling out of the money bullish put spreads because option implied volatilities are very, very high. And I want to take advantage of that extreme option implied volatility. So when I buy a longer term out of the money call debit spread, I'm selling a shorter term, shorter duration bullish put spread. Because option implied volatilities after those market drops are typically very, very high. So I need to make sure that I'm selling premium in there. Now, the other time when I'll buy a debit spread is on very short-term weekly options. So if I see a really nice market move coming up during the course of the week and I have some stocks that are particularly strong, I will buy a closer to the money call. Now they're usually still out of the money, and I'll sell a farther out call. And I'll do this for a debit. And the reason I like using debit spreads for them is because those out of the money calls that I've sold, number one, it helps me get into the position for a lower cost. But number two, as time decay is whittling away at both options, the ones that are further out of the money are very, very resilient. So even if the stock rallies, they tend not to go up in value very much relative to the options that are closer to the money. And I also tend to use this strategy when you've got some very, very expensive option premiums. Now, that could be simply because the stock is very volatile and the option IVs are high anyway, or it could be because the stock is very, very expensive. So these options tend to carry a lot of premium as well. So if you were trading Tesla, for instance, well, that's an expensive stock. There you would have expensive options and buying a closer to the money call and selling a farther out of the money call helps you enter that position at a lower cost. You'll be able to enter it. Stock makes it move. It's move, exit the position, take your profits. So I do buy debit spreads, but they tend to be short term in duration where I'm trading weekly options and I'm only holding the position perhaps overnight, maybe for 2 nights. And then the other instance where I like buying debit spreads would be on a very long-term basis after a big market drop and buying them way out of the money, buying them where I feel the stock has a very high degree of likelihood to get back to over a longer period of time. And even then, I'm still selling some out of the money, shorter term bullish put spreads to defray the cost of that position. I hope that all of this hasn't been too confusing for you. They are equivalent positions. There's some subtleties that make selling out of the money credit spreads more attractive to me than buying debit spreads. I hope I've addressed that issue. Again, if you're a novice trader, you really should learn how to trade vertical spreads. That should be one of your first strategies that you go to, not buying call options and buying put options. That should be way down the line. Once you get your consistency up, you get your market analysis skills down, you get your stock picking skills down. Those are the most important things. Once you have those down, then you can start to go into some option premium strategies. But if I had to put a number on it, I'd say I'm probably a buyer of options maybe 10% of the time and a seller of options about 90% of the time. Thanks for watching. I hope this information has been of use to you. If you want to take the 2-week free trial, you can go to www.oneoption.com. You can also register with the website and read my free ebook. That'll give you an idea of the systematic trading approach that we use. Market first, stock second, options last. Get the first two pieces of the puzzle right. You get the market right, you get the stock right. That is where your focus needs to be. The option strategies need to be very, very simple. They can be vertical spreads. You can buy the stock. Those are the strategies you should be really leaning on. And then as far as the vertical spreads also, if you're selling a credit spread and you want to be more bullish, then you simply go closer to the money. So instead of buying calls, you're selling a bullish put spread, but you're going closer to the money. So how close to the money you sell that spread is going to determine what your level of bullishness on the underlying is. Again, thanks so much for watching. I hope this has been educational for you. Have a good day. We'll see you in the chat room. Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.